You are listening to The Vocal Technologist. Spoken tech for your ears.
You know that the very specific lingering anxiety you get when you are staring at a smartphone software update notification.
Oh yeah, you are just hovering your finger over the install button.
Exactly. You are hovering there and you are trapped in this weird mental debate. You are wondering if this new download is going to magically fix everything that has been lagging and annoying about your phone.
Right?
Or, if it is going to completely break the entire device, wipe all your photos, and leave you entirely disconnected from the physical world.
It is a profound modern dilemma, really. You are caught right in the middle between the promise of a necessary upgrade and the sheer terror of a total system collapse.
Spot on. Nobody wants to be the person staring at a brick device.
Absolutely nobody.
Well, that feeling, that exact tension, is what the global financial system is experiencing right at this moment with the rise of decentralized networks.
It really is. We are watching the underlying code of money and human coordination get rewritten in real time.
And the stakes are infinitely higher than a broken smartphone. Here on the Vocal Technologist podcast, our focus for Web3 Wednesdays is to unpack and explore this incredible collision between artificial intelligence, traditional finance, and blockchain technology.
Because we are seeing entirely different technological domains merging into a new kind of infrastructure, it is not just finance anymore. It is computing, it is identity, and it is automation all colliding together.
Yeah, and our mission is to bring clarity to these massive shifts for you, the listener, with a touch of humor and some sharp expert analysis, because the sheer volume of information out there can be overwhelming, and you really need to know what actually matters without getting bogged down in all the technical jargon.
There's a lot to sift through.
Too right. So let's get straight into it. We are starting with a pretty mind-bending concept. I was reading up on artificial intelligence agents, and it turns out they're no longer just chatting with us in a text box or, writing polite emails.
Not anymore.
They're doing their own shopping. The machines are actually getting wallets.
We are moving exceptionally fast here. From artificial intelligence as a simple advisory tool to artificial intelligence as an autonomous economic actor. To really understand where this is heading, we have to look at the thesis from Ilya Polasukin. He is the co-founder of the NEAR protocol.
Right.
And he argues that artificial intelligence will soon become the primary user of blockchains. Full stop.
Okay, let us pause and unpack this for a second. Why would an autonomous program even need a blockchain? Why can it not just use a standard bank account or a corporate credit card tied to the developers who built it?
Well, the primary barrier there is that traditional finance strictly requires a human identity or a registered corporate entity.
Right, and artificial intelligence cannot exactly walk into a local bank branch.
Exactly. It cannot walk in with a passport and proof of address to open a transaction account. Blockchains, however, provide a neutral, permissionless back-end infrastructure.
Which means anyone can use it for anything.
Yes. They allow an autonomous agent to verify ownership, hold digital assets, and settle payments instantly without any human intervention or bureaucratic bottlenecks. Polasukin believes humans will eventually just interact with the interface layer.
While the artificial intelligence handles all the complex on-chain coordination and purchasing beneath the surface.
Precisely.
But wait, if an artificial intelligence is making thousands of micro decisions and tiny transactions every single second, how does it avoid getting absolutely crushed by network gas fees? Because if I send money on a decentralized network, I usually pay a fee. It seems like the math would make high-frequency agentic commerce completely impossible.
And that is the exact technical hurdle that held this back for years.
So
which brings us to the X402 protocol and Circle Nano payments. This is the infrastructure making agent-to-agent commerce mathematically viable.
Okay, how small are we talking?
We are talking about the ability to send fractions of a cent. Amounts as small as $0.000001. Completely avoiding those massive network fees that used to make microtransactions impossible.
But how does the network even process a payment that small without the computing cost outweighing the value of the transaction itself?
It uses a brilliant architectural design involving off-chain authorization. Instead of putting every single tiny transaction onto the public ledger individually, the buyers sign cryptographic authorization messages off the main network.
Okay, so they're kept separate initially.
Yes, these signatures are routed through a gateway that operates inside Amazon Web Services Nitro enclaves.
Ah, I've read about those enclaves. They are essentially mathematically secure, isolated black boxes in the cloud, right?
That is a great way to visualize it. The enclave creates a highly secure, isolated environment where nobody, not even the server administrator, can peek inside or tamper with the data.
That is wild.
It really is. The system aggregates thousands of these tiny microtransactions within the enclave and then processes them in a single periodic batch transaction on the main network.
So it is kind of like running a tab at your local cafe. You order coffee all week, but you only settle the whole bill at the end of the month. Except in this case, the tab is secured mathematically in a locked digital vault.
That is spot on, and the initial deposit is the only major transaction. Once that is locked in, the artificial intelligence can stream payments instantly. This makes true pay-as-you-go compute a reality.
Meaning it only pays for what it uses.
Exactly. An autonomous agent can dynamically buy server processing power, paying exactly for what it consumes down to the absolute microsecond without asking a human for permission.
And we are already seeing examples of this happening in the wild, which is fascinating. I was looking at agents.house on the Solana network. They're taking these personas and turning them into tradable digital assets with their own persistent memory in their own wallets.
They are actively competing against one another, too, gathering market intelligence and earning tips from users. It repositions these agents from being just disposable pieces of code to being reputation-bearing assets that actually accumulate wealth.
Incredible. And you also have the Virtuals Protocol and Fabric Foundation launching the Robo Token.
Yes.
That is the one bridging into the physical world, correct? Tell us how the Robo Token actually functions.
It acts as a settlement currency for physical robots to get paid for their direct labor. Community members can fund a fleet of robotic hardware, and employers pay for the physical tasks using this specific token.
So the robots are earning their own keep.
Essentially, yes. It applies verifiable identity and programmable financial incentives directly to hardware operating in the real world.
So what does this all mean for you listening right now? I think the big takeaway is that autonomous agents could mediate trillions of dollars in consumer commerce by the end of the decade.
Easily.
We are watching the internet fundamentally shift from human to merchant transactions toward completely machine-to-machine economies. Your personal digital assistant could soon be negotiating and transacting with a server entirely in the background while you sleep.
Which is a profound structural shift for the global economy. But while the machines are figuring out microtransactions, the old guard of traditional finance is definitely not sitting this out.
Not at all.
Traditional banking giants are making massive infrastructure moves quietly in the background.
That is a perfect pivot, actually, because Kraken, which is a Federal Reserve master account for its Wyoming chartered banking arm.
Yes, they did.
For an industry that has historically been locked out of traditional banking, this feels absolutely huge.
It sets a massive precedent. Securing a master account gives them direct access to Fedwire for the very first time. They no longer need to rely on vulnerable intermediary banks to settle United States dollar transfers.
They're plugged straight in.
Exactly. It plugs a digital asset firm directly into the core payment infrastructure of the Federal Reserve itself.
And the global integration of these digital dollars is accelerating rapidly across the board. Visa and Bridge are expanding their stablecoin-linked cards to over 100 countries.
The scale of that is incredible.
It is. This unlocks stablecoin payments at over 175 million merchants globally. You can spend digital dollars anywhere Visa is accepted without the merchant even knowing you're using decentralized infrastructure.
We are also seeing SoFi and Mastercard partnering to let global transactions settle in SoFi USD, which is a fully reserved digital dollar issued by a regulated bank.
Right.
Furthermore, Western Union just launched the USDPT token on the Solana network. This is specifically to target the massive global remittance market, which sits at around $905 billion annually.
The small and medium business angle here is what really stands out to me, because this is not just theoretical, high finance, or obscure cryptography. It solves a massive, painful problem for regular businesses trying to operate globally.
It really does. If we look at a platform like Slash, they have reached $1 billion in volume simply by helping small and medium businesses bypass the sluggish, multi-day settlement of traditional international banking.
Paint a picture of that for us.
Imagine a mid-sized business generating $50,000 to $500,000 annually in cross-border trade. Traditional banking fees could cost them tens of thousands of dollars a year, and they are forced to wait 3 to 5 business days for funds to clear.
That is completely crushing for a small business trying to manage cash flow and pay local suppliers.
It stifles growth entirely, but Slash delivers 2-minute finality for approximately $2 per transaction using these digital dollars.
$2 instead of thousands.
Exactly. It completely changes the unit economics for international trade, allowing small businesses to operate with the financial velocity of a multinational corporation.
Now, we do need to look at the regulatory reaction to this explosion of activity. Governments are obviously watching billions of dollars move outside the traditional banking system.
And they are reacting.
Yes. The Financial Action Task Force recently issued a warning stating that stablecoins now dominate illicit virtual asset volumes.
Their latest report indicates that these digital dollars account for 84% of illicit transaction volume. They specifically point to sanctions evasion by state-linked actors like Iran and North Korea.
Which is a serious concern for global regulator.
Absolutely. They highlight peer-to-peer transfers using unhosted wallets as a critical vulnerability because that method completely bypasses traditional compliance and surveillance controls.
On top of that, in the United States, the Office of the Comptroller of the Currency is proposing the Genius Act. This legislation aims to regulate and potentially restrict yield-bearing arrangements between issuers and exchange platforms.
The concern from the regulator is that these arrangements might circumvent established banking prohibitions.
Right. It is a clear push to bring this parallel financial system under strict federal oversight before it grows too large to contain.
Regulators are essentially attempting to map analog frameworks onto entirely digital infrastructure. It is an ongoing tension between the frictionless efficiency of the new technology and the necessary oversight mechanisms of the state.
That tension reminds me of how these new financial rails are truly tested when real-world geopolitical events cause absolute chaos.
Stress tests.
Exactly. When extreme volatility hits, you see exactly how robust a financial system really is.
A perfect example of that was the market reaction to the United States and Israeli missile strikes on Iran.
When those strikes occurred, the traditional stock and commodity markets were closed for the weekend. Traders holding massive risk had zero way to exit their positions on Wall Street.
They were trapped.
So they migrated to decentralized platforms like Hyperliquid to hedge their commodity exposure.
This highlights the structural advantage of around-the-clock markets. Traditional commodity markets trap investors in their positions from Friday afternoon until Monday morning.
Which feels archaic when news breaks on a Saturday.
Completely. But on decentralized exchanges, traders could take real-time positions as the news broke. We saw immediate spikes in oil and gold-linked contracts.
And Bitcoin reacted too.
Bitcoin saw a temporary drop down to $63,000 as risk-off sentiment hit the broader market. But then it rebounded strongly above $71,000 once the scope of the strikes became clear.
The fact that a trader can hedge global commodity risk on a decentralized exchange at 2 in the morning on a Sunday is wild.
It changes the entire paradigm of risk management.
But it was not just commodities reacting. The prediction market drama was intense. Polymarket saw record-breaking volume with over $500 million in war prediction bets.
This raises critical questions about information asymmetry in permissionless systems.
Absolutely. There was significant controversy because on-chain data showed 6 suspected insider wallets made over $1 million by betting on the strike just 71 minutes before the public news broke.
That is the double-edged sword of these open platforms. The settlement is mathematically perfect, and the payouts are instant. But the flow of information can still be manipulated by those closest to the physical event.
If you know a strike is happening before the major news networks report it, you can essentially drain the liquidity from the prediction market.
Yes. Now, if we zoom out from the immediate geopolitical shocks and look at the macroeconomics driving all of this, we are witnessing a structural regime shift.
Let's get into that.
Gold is fundamentally decoupling from real interest rates. Historically, when real yields were stable or rising, gold would not surge this aggressively.
Right.
But it has rallied massively, and analysts attribute this directly to massive, unsustainable global debt. The United States alone is adding roughly $8 billion of debt every single day.
$8 billion a day.
Yeah.
That is a number that the human brain is not really equipped to comprehend.
It is staggering.
And central banks are hoarding gold like never before to hedge against this debt. They absorbed hundreds of tons recently.
Yeah.
But contrast that central bank gold buying with what the retail and institutional sectors are doing with the Bitcoin spot exchange-traded funds.
We are seeing a profound divergence in strategy here. Central banks are buying the analog store of value, while private capital and institutional funds are absorbing the digital equivalent.
Both looking for a lifeboat, but choosing different vessels.
Exactly. We're even seeing corporate balance sheets taking unprecedented risks to opt out of the fiat system. SpaceX, for example, is holding over $500 million in Bitcoin on its balance sheet.
Which adds extreme, unpredictable volatility to their upcoming $50 billion initial public offering. Imagine being the lawyer writing the risk disclosure for that prospectus.
Good luck to them.
Your space exploration company is not just exposed to rocket launch failures, but also heavily exposed to the weekend price swings of a decentralized currency.
It definitely complicates the standard valuation models for traditional equity investors who just want clean exposure to the aerospace sector.
So with artificial intelligence shopping autonomously, traditional finance settling billions in stablecoins, and around-the-clock global hedging during geopolitical crises, the underlying code of these blockchains requires some radical upgrades to handle the load.
It has to upgrade. The system cannot scale on its original architecture.
The foundation just is not built for it.
The current foundation is simply not built for the scale and complexity of what is coming over the next decade. This is why we are seeing a massive evolution in Ethereum, specifically with Vitalik Buterin pushing for EIP 8141.
I saw this proposal, EIP 8141, but I really need you to translate that into English for me, because it sounds like a droid from Star Wars.
It does a bit.
It is described as an omnibus account abstraction proposal. What does that actually mean for the average user?
At its core, account abstraction means your digital wallet will start functioning much more like a smart programmable bank account rather than just a dumb vault for your private keys.
Oh, yeah, that makes sense.
It introduces what are called frame transactions. These are bundle operations that allow much more flexibility directly at the protocol layer, meaning users can pay gas fees in different tokens or set up recurring payments safely.
Which brings it much closer to a traditional banking experience.
Exactly. But the most critical aspect for the long-term survival of the network is how EIP 8141 addresses the looming quantum computing threat.
Because a powerful enough quantum computer could theoretically break the cryptographic keys that currently secure every single wallet and smart contract on the network, effectively draining hundreds of billions of dollars.
Which would be catastrophic. So EIP 8141 helps make the network quantum resistant by ensuring cryptographic keys are strictly single-use.
Let us explore how that works mechanically, because it is a brilliant solution to a genuinely terrifying problem.
Currently, you use the same public and private key pair for years. That stationary target gives a future quantum computer ample time to try and crack the underlying encryption.
It's just sitting there waiting to be broken.
Right. With this new proposal, the keys rotate during every single transaction. The contract address stays exactly the same, so your wallet looks identical to you and your friends, but the underlying cryptography is used once to sign the transaction and then permanently discarded.
Wow.
If a quantum computer cracks the key after the fact, it does not matter at all, because that specific key is entirely useless for any future transactions.
It is like changing the mathematical locks on your front door every single time you turn the key to leave the house.
That is a perfect analogy.
It completely neutralizes the threat without having to throw away the whole house and start over. Now, that same instinct for radical survival and upgrade is happening in decentralized governance right now too, specifically over at MetaDO with this concept of futarchy.
This is fascinating. Traditional decentralized governance often struggles because voting simply reflects political dynamics, popularity contests, or the outsized influence of a few massive token holders who sway the results.
The whales just dictate everything.
Yes. Futarchy replaces political voting with market-driven betting.
It essentially forces participants to put their money where their mouth is, rather than just voting based on vibes.
The underlying concept is that market prices provide significantly more accurate signals than human votes. If you propose a change, the community trades tokens based on two parallel outcomes.
Okay.
If the market determines the token will be worth more if the proposal passes, it passes. Token holders recently used this ruthless mechanism to liquidate a startup called Ranger Finance.
This particular startup had raised $8 million through the platform. But the community felt the developers were not delivering on their promises at all.
We were stalling.
So instead of just complaining on forums or begging the founders for a refund, they used futarchy. The market collectively determined that liquidating the project entirely and returning the remaining funds yielded more expected value than letting the startup continue its operations.
So the proposal passed automatically based purely on the trading data. They essentially burned the project tokens to return the treasury funds pro rata to the original investors.
Brutal but effective.
Very. It merged market liquidity and community governance into a single, brutal, but highly efficient feedback loop.
It acts as a permissionless kill switch. For years, retail investors have been trapped in bad fundraising cycles with zero way out when a project fails to deliver.
They just have to watch the value go to zero.
Right. But this finally gives them an exit recourse based entirely on market mechanics. It is a fascinating stress test for a completely new model of human coordination.
The implications for corporate governance are massive if this model proves scalable beyond just digital asset communities.
We have covered incredible ground here. From autonomous agents paying for their own server costs and microtransactions to traditional banks quietly building global settlement networks, and completely new ways of voting with your wallet to liquidate underperforming startups.
It has been huge.
But I want to leave you, the listener, with a final wild idea to ponder on your own.
I am curious to hear where you are taking this.
Well, we talked about artificial intelligence agents getting wallets and trading tokens autonomously. But think about the logical conclusion of that trajectory. What happens to the global economy when an autonomous agent, using these new frictionless financial rails, successfully accumulates $1 billion of on-chain wealth?
Okay.
And then it decides it wants to start hiring human employees to do the physical tasks it cannot do itself. Who is really working for who at that point?
The line between a software program and an employer might blur much faster than anyone anticipates.
Something to mull over while you sip your coffee. Thank you so much for tuning in and exploring these concepts with us. If you enjoyed this conversation, please hit that subscribe button so you never miss an episode of Vocal Technologist. We love unpacking these ideas for you, and subscribing is the best way to support the show. Keep questioning everything and stay curious.
Spoken Tech for your ears.